They call it steady. Banks use that word when they don't want to say the truth out loud. Because steady in global finance doesn't mean healthy. It means nothing is growing, but everything is afraid to admit it. Trade finance revenue across Europe and Asia didn't surge, it didn't expand, it didn't evolve, it merely survived. And in 2025, survival isn't success, it's a warning sign. Before we go further, understand this clearly. Trade finance is not a niche banking product, it's a lubrication system of global power. Letters of credits, guarantees, receivable finances, these instruments decide who gets paid, who gets trusted, who gets to trade at scale. Wars are fought with weapons, empires are built with credit, and right now that credit engine is slowing selectively. European banks reported stable trade finance revenue in 2024. Let's translate that. No expansion of balance sheets, no aggressive risk taking, no new trade corridors, no strategic dominance. Europe is not leading trade, it's maintaining legacy flows. Overregulation has turned European banks into caretakers of yesterday's system. Basel rules choke capital, compliance replaces judgment, risk departments run the show. Europe didn't lose trade finance overnight, it regulates itself out of relevance. And Asia isn't winning either. Asian hubs, Singapore, Hong Kong, also reported flat results. That surprises people. Asia trades more, Asia manufactures more, Asia moves faster. So why no surge? Because global trade isn't expanding, it's fragmenting. Supply chains are shorter, finance tenors are tighter, trust is conditional. Asian banks are cautious because they see what's coming, and they are right to hesitate. Now pay attention. This article quietly admits something important. Growth is coming from Middle East and Brazil. That's not coincidence, that's structure. Middle East, energy cash, sovereign backing, political alignment between state and banks, high tolerance for geopolitical risk. Brazil, commodity dominance, South South trade routes, less ideology, more pragmatism. These regions finance movement, not only narrative. They don't ask, is this politically elegant? They ask, will it move goods, money, and leverage? That's power logic. Now let's talk about the real threat. 2025 is being shaped by aggressive US trade policy. Tariffs are no longer symbolic, they are structural weapons. What does tariffs really do? Force rerouting of trade, increasing financing costs, shorten trust change, stress test banks, not exporters. When tariffs hit, trade finance doesn't expand, it hardens. Banks retreat to guarantees, collateral, shorter maturities, trusted counterparts only. Weak firms get cut out. Marginal countries get excluded. This is not volatility, this is financial Darwinism. Darwinism, pardon. Let's look at the relatable headlines. Receivable frauds, inventory manipulation, post-date transaction, phantom trade flows. When this happens, it results in margin shrinking, credit tightens, everyone is desperate to appear solvent. Fraud doesn't spike in booms, it spikes in compressed system. Trade finance is becoming a closed club again, and closed clubs always breed deceptions at the edge. Trade finance isn't collapsing, it's concentrating. Fewer banks, fewer corridors, more gatekeeping. The future belongs to the institution that accepts global geopolitical risk, align with state power, control commodity flows, finance trade without moral hesitation. Europe has administered this in the past. Middle East is the finance of the future. Emerging corridors will decide who eats. This is the real battlefield of 2025.